The stock market was crashing. Panic on every screen. Phones lighting up. Trillions evaporating. And then, suddenly, everything stopped. A sharp reversal. A historic recovery. What no one saw was the phone call. One call, made from inside Washington. And just like that, Wall Street was saved. But saved by who? And why does this keep happening? The phone call that saves Wall Street. There's a group that only appears when the market is bleeding. No cameras, no statements, just quiet action behind the curtain. They don't need approval. They don't ask permission. And according to some, they can stop a crash with a single trade. They have a formal title, but behind closed doors, they're known as the Plunge Protection Team. This isn't a conspiracy theory. It's a system, a hidden layer of control embedded deep in the financial machine. A story that begins in chaos and ends with a terrifying question. What if the bull market isn't real? Who decides when fear ends? Who keeps the illusion alive? And who makes the phone call? It all begins in 1987, the day the market fell and never fully hit the ground. October 19th, 1987. The Dow Jones opens red. Nothing unusual at first, but within minutes, the floor shifts. By mid-morning, traders stop shouting. They're just staring. Terminals blinking, phones silent. No buyers, no bottom. The market is in free fall. Not 5%, not 10%. By the time the closing bell rings, the Dow has collapsed by 22.6% in a single day. Black Monday. The worst one-day crash in U.S. stock market history. Worse than 1929. Faster than anything Wall Street had ever seen. Behind the scenes, it wasn't just money vanishing. It was faith. Faith in the system, in the idea that someone, anyone, was in control. Because that day, no one was. Not the Federal Reserve, not the Treasury, not the SEC. Each one reacted differently. Each one acted alone. And the result? Chaos. President Reagan was briefed in real time. Alan Greenspan was weeks away from becoming Fed chair. And for the first time, policymakers realized there was no plan. No coordinated response team. No protocol for market collapse. Just a loosely connected web of institutions watching the system eat itself alive. In private memos after the crash, officials admitted the obvious. Wall Street had nearly imploded under its own weight, and no one had the tools to stop it. So they built something. Not a public task force, not a congressional commission, but a small, high-level working group, unannounced, unregulated, unaccountable. Its mission? To maintain integrity, efficiency, order, and competitiveness in financial markets. Its members? The Secretary of the Treasury, the Chair of the Federal Reserve, the head of the SEC, the head of the CFTC. Only 4 people, with reach across every layer of the financial system. Its name sounded harmless, the President's Working Group on Financial Markets, but insiders quickly gave it a different label, the Plunge Protection Team. And that name stuck. Because within elite trading circles, a rumor had already begun to spread that this team had one true purpose: to prevent the next Black Monday by any means necessary. What does that mean in practice? It's still unclear. There were no official press briefings, no transparency, only a rising pattern. Crashes that didn't crash, panics that reversed overnight. Was it intervention? Was it coordination? Or just Incredibly well-timed luck. Whatever it was, the market would never feel the same again. Because now, traders started asking a new question. What happens when the floor falls out again and the phone rings? What happens when the floor falls out again and the phone rings? That question didn't just echo through Wall Street, it spread. Whispers in trading desks, rumors at hedge fund dinners, speculations hidden between CNBC segments. By the mid-1990s, the phrase Plunge Protection Team had become a kind of financial folklore. Everyone in the room had heard of it, but no one, not one official, would ever say it out loud. It wasn't listed on government websites, it wasn't part of any public strategy, and yet its fingerprints were showing up in the most suspicious places. Take October 28, 1997. Markets tanked again, fast, over 500 points down, and just as before, a sharp reversal. Alan Greenspan, now Fed chair, had made a few curious phone calls that morning. No transcript, no public record, just a quiet bounce that no one could fully explain. Analysts were baffled, but insiders, they nodded. They had seen this before. And then, in 2000, something odd happened. A Washington Post article used the name Plunge Protection Team for the first time in print. Half joking, half warning, but it was out. The phrase had escaped. Still, no one in government acknowledged it. No Fed chair, no Treasury secretary. Reporters asked. They laughed it off. It's just a nickname, they said. A conspiracy theory, they added. But here's the strange part. If it's not real, why does everyone who's close to power know exactly what it is? Private investors started tracking the signs. Patterns in futures contracts, volume spikes minutes before closing, mysterious buying pressure when everything else pointed down. They called it the invisible bid, a hidden force that propped up the market when things got ugly. In 2008, during the financial crisis, that force reappeared. Banks collapsing, Lehman gone, panic everywhere. And then, somehow, the bleeding slowed. Bernanke and Paulson gave speeches, stimulus packages were announced. But beneath it all, traders noticed something else. Coordinated market activity that couldn't be explained by news alone. Huge blocks of index futures bought in pre-market hours, sudden shifts in volatility, support at key technical levels that looked designed. Was it central banks? Was it the Fed? Or was it something else entirely? A mechanism built in the shadows of 1987, now fully activated. One former official speaking anonymously to the Financial Times said, "There are tools we don't talk about because we don't want people to depend on them, but they're there, always have been." No confirmation, no denial, just enough to fuel the suspicion. And then came the most critical pattern of all. The closer we get to systemic collapse, the quieter the room becomes. Fewer leaks, faster reversals, more precision. As if someone had done this before. And if that's true, if there's really a hand catching the fall every time, then the next logical question becomes, how does it work? And more importantly, how fast can it act? How fast can it act? That's the question traders still can't answer. Because whatever this mechanism is, you never see it moving. You only see the results. Like in February 5th, 2018. The Dow Jones plunged over 1,100 points in a single session, the largest intraday point drop in history at that time. And then, within hours, the panic was gone. No new policy, no emergency Fed meeting, just an invisible hand catching the knife. Some analysts blamed technical factors. Others pointed to algorithmic traders. But deep inside hedge funds and proprietary trading desks, a different theory emerged. That somewhere, perhaps inside the New York Fed, or even deeper, a set of tools had been preloaded. These tools weren't for the public, they weren't on the books, but they could inject liquidity, purchase futures, or trigger market confidence by acting through proxies. The idea? Don't just stabilize markets with words, stabilize them with force. And if insights like this resonate with you, if you're the kind of person who wants to understand what really moves the world, go ahead and hit the like button. It doesn't just help the channel, it tells the system you're watching, and that you're not watching blindly. It's not just theory, because in December 2018, something happened that was harder to explain. Markets were in free fall, again, a brutal sell-off leading into the holidays. And then late on a Sunday night, Steven Mnuchin, Treasury Secretary at the time, announced that he had called the heads of the 6 largest U.S. banks. He didn't say why. He just said they were well capitalized and that liquidity was ample. But traders immediately recognized the message. The call had been made, and by Monday, the market bounced, over 1,000 points up in a single session, one of the largest Christmas Eve rallies in history at that time. No major earnings, no macro news, just one curious move behind the curtain. The press called it the Mnuchin call, but among insiders, it had a different name, the signal. Because that's how this mechanism operates, not by official decree, not by press release, but by symbolic action. Private meetings, quiet calls, discreet orders placed in markets through intermediaries. It's not illegal, but it's not exactly democratic either. It bypasses the public. It skips the vote. It intervenes when the system is too fragile to let reality unfold. And every time it happens, the result is the same. A sell-off suddenly reversed. A bull market miraculously preserved. Some say it's for the greater good, that letting markets crash naturally would cause more pain, that someone has to stop the panic. But others, they see something more dangerous. A system where the illusion of free markets is maintained by invisible strings, where the rules apply until they don't. And that leads to one of the most uncomfortable questions yet. If markets are protected, who's profiting from the protection? And more importantly, who controls when the protection ends?
For years, the phone call was just a metaphor, a symbol of silent intervention, a whisper between power brokers. But in March 2020, that metaphor became real. The world was grinding to a halt. Markets were spiraling fast. The Dow Jones dropped over 10,000 points in less than 2 weeks. It was the fastest collapse since 1987. Panic wasn't building, it had arrived. And then, the call happened. Not one, dozens. Between the Treasury, the Federal Reserve, the heads of major banks, and even global financial authorities. But these weren't panic calls, they were coordination calls. And what followed was unlike anything markets had ever seen. The Fed slashed interest rates to near zero on a Sunday. They injected trillions into funding markets. They committed to buying corporate bonds, something they had never done before. And behind the scenes, financial institutions suddenly had access to near unlimited liquidity. Futures markets stabilized, volatility cooled, and stocks roared back. Even as the real economy was under immense pressure. Empty streets, job losses mounting, businesses closing their doors. Yet the market kept climbing. For many, it didn't make sense. But to those watching closely, it was the clearest signal yet. The system had been activated. The mechanism, the one built in 1987, reinforced after 2008, and quietly rehearsed ever since, was now fully operational. This wasn't about preventing panic. It was about manufacturing calm. And the most unsettling part? It worked. The stock market recovered in record time. The S&P 500 broke new highs just months after the collapse. Tech stocks surged, crypto boomed, and a generation of new investors poured into the market, believing it could never fall again. Because every time it did, it came back, stronger, faster, almost scripted. And maybe that's the most dangerous illusion of all, that markets always recover. Because now it's not just traders relying on the bounce, it's pensions, municipal budgets, corporate debt structures, entire economic frameworks built on the assumption that the bull will never die. But what if that assumption is based on a mechanism that can't always be used? What if, the next time, the call doesn't come? Because behind every intervention, there's a limit, a threshold, a decision. And the moment that decision is delayed, even for a few hours, the illusion collapses. So the final question isn't how the call works. It's this: what happens if no one picks up? There's something strange about silence in the markets. It's never truly quiet, but sometimes it feels quiet. The kind of quiet that comes before a storm. And lately, that silence has been growing. Volatility drops, everyone's buying the dip, the fear is gone. But ask any seasoned trader and they'll tell you the same thing. That's when you should worry most. Because the real danger isn't when people panic, it's when they stop. And here's what no one likes to admit. The mechanism we've relied on for decades, the one that catches the market when it falls, might already be reaching its limit. In 2023, central banks began pulling back. Interest rates rose, liquidity thinned, and for the first time in years, the markets had to walk without a net. No massive injections, no sudden reversals, no mysterious invisible bid, just pure exposure. And when the cracks appeared, something even more unsettling happened. Nothing. No signal, no call, no rescue, just silence. The phone didn't ring. And for a moment, the system blinked. Stocks dipped, then dipped again. Retail traders waited for the bounce, but it didn't come, because this time the mechanism didn't fire. Not because it failed, but because someone, somewhere, chose not to activate it. And that's the core of the fear. Not that the Plunge Protection Team doesn't exist, but that it does. And it's selective. It doesn't serve everyone. It doesn't trigger on every fall. And it doesn't answer to the public. It answers to itself, which means the next crash might not be an accident. It might be allowed. So the question we've been asking, who makes the call, may be the wrong one. Maybe the real question is, what happens when the silence is intentional? Somewhere in Washington, behind a locked door, there's a list. A list of triggers, thresholds, moments when the system decides the market is no longer allowed to fall. And next to that list is a phone. Not red, not glowing, just waiting. Because that's how the real market works. Not with charts or news or sentiment, but with decisions made in silence by people you'll never see. You can trade, you can invest, but the floor you're standing on, it's not made of stone. It's a switch, and you won't know it's off until it's too late. If you're still here, you're not just watching, you're paying attention, and that makes you different. So if this truth matters to you, if you want more stories that pull back the curtain, hit the like button, subscribe, and stay sharp, because the next crash won't send a warning. It'll just stop bouncing.